Good morning and welcome to our session on sustainable investing. We have a full room this morning. You know, the term impact investing, which is investments designed with intent for social or environmental return, it was coined in 2007. And since then, the impact investing sector has attracted significant attention in the media, among investors, and the public more generally. Interest in impact investing has been strongest among millennials, the generation born between 1980 and 2000. In the U.S. alone, there are 80 million millennials. And this is what they think about impact investing. There's a study by a U.S. trust. Percentage of respondents who agree, my investment decisions are a way to express my social, political, or environmental values. Millennials, 2/3 of whom agree with that statement. Baby boomers like me, where only 1/3 of us are in that category. Interesting correlation there. Second question, just two questions I'm pulling up from the survey on the right. It is possible to achieve market rate returns investing in companies based on their social or environmental impact. Again, millennials lead the pack. Almost three quarters of them agreeing with that statement. So why does that matter? Well, this conference is about millennials, so I want to start with that. But there's another reason it matters what millennials' opinion is on impact investing. And it's what we call the golden rule. He or she who has the gold makes the rules. Millennials are forecast to be the beneficiaries of the greatest transfer of intergenerational wealth ever seen. As much as $40 trillion will be transferred over the next 40 years as the baby boomer generation, my generation, ages and transfers their assets to their children. That transfer has already begun in the last couple of years and will continue to accelerate through about 2040. There's an extraordinary movement of assets and wealth to this generation that really cares about these issues and sees impact investing or sustainable finance as a route for them to translate those cares into their actions. So I've asked today's panel to speak about their activities in this sector. Each of them is going to spend just 5-10 minutes at most talking about their activity in the sectors, the key challenges they encounter in their sector, and the challenges faced by the industry at large. And then we're going to open up right away to audience discussion. So I think we're going to have a lot of time for Q&A and discussion, and I very much look forward to moderating that. So let me get us right into the presentations. And we'll start with Melissa Cheong. Melissa is Director of Private Credit and Direct Investing at Imprint Capital, one of the first and leading impact investing advisors focused exclusively on this sector. So please join me in welcoming Melissa.
Good morning, everyone. Thanks for having me, Bruce. Can you hear me, everyone? Okay. Good morning. Thanks for having me here today. It's a real pleasure to be here at the event. Imprint, hold on a second. The clicker's not working. Got it. Okay. Got it. Sorry about that. So, Imprint was founded in 2007 and is a fully dedicated registered investment advisor focused exclusively on impact investing. We have offices in both New York and San Francisco with 16 people who are exclusively focused on sourcing, diligencing, and executing impact investments for our clients. The clients that we cover are across three primary segments: foundations, families, and financial institutions. And with each of those clients, I think what we do that's differentiated in the market is to work to create customized impact investment portfolios to address clients' individual financial as well as mission-specific needs. So I think what's interesting here is that if you look at the 120 different impact investments that we've made since formation in 2007, almost 80% of those were in private markets. So that gives you a sense of the kinds of deals that we're looking at for clients. And if you look at our AUM as of second quarter of 2014, I think the number is actually closer to 450 as we near the end of the year now. But it gives you a sense of how small the deals are relative to, I think, what you see in the market more broadly. I think it's also interesting to see that half of our clients are actually high net worths and family offices or family foundations. Of the other half of that bucket, I think that it's also notable that 10 of the 25 largest foundations are clients. We also work with financial institutions, wealth advisors, large insurance companies, and we are starting to see more interest from other institutional investors as well. I think in trying to understand how our clients sit within the overall market, I think what's interesting to hear about is how we work and interface with these three different buckets of clients that we work with. So within the private banks, financial institutions, and asset consultants, there are three different primary ways which we can actually work to support client needs. One, we can provide clients with access to our existing research and the deals that we have on our existing platform, and help them to both attract prospects. And Bruce brought up the topic of millennials. I think we see a lot of situations where we'll have a client, a wealth advisor who has an established relationship with a family, and there will be a push from generation 2 where there's an anticipated transfer of wealth coming, and the younger generation is really pushing mom and dad to start thinking about impact investing as something that they're actually really engaged in. And for Generation 1, it's a way for them to get their children and later generations more engaged in the work that they're doing from a financial management perspective. So I think from a business development perspective, we see a lot of that coming from the wealth advisor channel, and we can do whatever we can to support those clients given different mission interests and financial parameters. We can also help wealth advisors fill out their existing platforms. What that means is helping them to develop products and find ways to create scalable ways to put client capital into existing funds. We act as a sub-advisor for a wealth advisor with relation to a private equity impact fund of funds, and we also have a sub-advisory arrangement with another private wealth advisor where we help them find private credit opportunities for clients who are interested in the space. The third way that we work with wealth advisors is to help create customized impact investment carve-outs from their portfolios. And so what we'll do there is we'll create separate managed accounts which touch upon and address the different needs that their existing wealth advisors or their clients are seeking to accomplish. And so what that means is looking to understand what the client is seeking to accomplish from a mission perspective as well as financial returns perspective. And so we'll look across asset classes and mission areas and find the investments that are appropriate for both the family from a mission perspective, but also help them address existing asset allocation preferences which have been established by their traditional wealth advisors. With family offices, I think we provide the same three services that we're providing to the private banks and the wealth advisors, but the difference there is that I think the relationship is just a little bit more intimate and a little bit more direct. So there we'll integrate with existing family office teams, family members, and advisors and help them to figure out what it is they're seeking to accomplish. So what that means is helping them to establish strategy. Sometimes what we'll find is the family office will be stuck. They'll have made the decision years ago that they want to do this work, and they're all excited about it, and there's a lot of momentum internally, but they're not quite sure how to do it. So what that means is we'll sit down with them, we'll help them to develop a strategy, map out the areas that they're interested in, create market maps, and help them understand the landscape, and then do the research which is necessary to find them the investment opportunities which actually address their different needs. So again, interesting situations come up where you have Gen 2 with a very different perspective than Gen 1. So working to reconcile that and find a way to meet in the middle is something that I think we've learned that we have to do with relation to family offices and individuals. With foundations and charities, this is actually where Imprint's business started initially. So when I joined the firm 4 years ago, our clients were almost exclusively large national foundations. working with foundations is a gift in many ways, in that they give you the ability to create research and resources that you wouldn't ordinarily be able to from a platform building perspective. I think they have funded and have helped us to become deeply knowledgeable in certain sectors, in energy efficiency, in health and wellness, and in global development. A lot of the scanning work which we've done in the market and the work that's been done to invest in building a knowledge base has been funded by a lot of our foundation clients. So there the work tends to be much more program related, where we'll work closely with program officers to help them understand what's possible given their program focuses and what they're seeking to accomplish from an impact perspective. Oh wait, sorry. Here we go. These are the different sectors that we cover from an impact perspective. So energy and the environment, developing world, food and well-being, education, and communities. So within each of these sectors, we have a research lead who covers, is responsible for covering the entire sector, mines the universe for investment opportunities, is constantly out in the market trying to understand how these issues affect the opportunities that we have on our existing platform, as well as opportunities that we think we need to start digging into. We try to be ahead of the curve with relation to anticipating client demand, and so if we think there's a hot issue in a certain sector, we'll invest substantial resources into understanding when it makes sense to really dig in and get smart in a given area. For example, within energy and the environment right now, I think community solar is something that's become really interesting to many of our clients. Within developing world, we have a platform of probably 12 private equity funds, which we've done diligence and that are on our platform and we're actively putting clients into. Within food and health and well-being, we found that the best way to approach the sector is to look for very specific direct investments, and so my team tends to play a heavy role with relation to that work. Education also. I think the best way that we've realized to touch that market is through direct investments. There just aren't enough fund managers which make it possible to place capital into private equity funds. So here, I think what's interesting is that if you look at the broad set of deals which we've done across asset classes, geographies, and impact sectors, the work is still overwhelmingly domestic. So I think this slide is always really surprising to everyone on my team, because if you look at this, 71% of our work has been done in the U.S., although it feels like most of our pipeline over the last year has really been emerging market based. And so I think that's a trend which I think we'll continue to see changing. I think as family offices continue to be a growing part of our existing business, we're realizing that's a sector which is very interesting to them and that will continue to grow. So I guess the takeaways here are the ways that I think we see our clients needing and trying to get into the market is with relation to the support services that we provide for them. Strategy development, helping to get programs off the ground. Research and market scanning, helping them to find interesting opportunities across multiple impact areas and asset class opportunities. And then investment management, helping to manage existing portfolios and on a continuing basis help to do impact reporting and understand how their mission objectives and their financial objectives are being met through reporting. So, thank you.
Thank you, Melissa. Audrey Choi is CEO of Morgan Stanley's Institute for Sustainable Investing. She's also a managing director and head of Morgan Stanley's Global Sustainable Finance Group. She was also previously, earlier in her career, Chief of Staff of the Council of Economic Advisors in the White House under the Clinton administration.
Thanks very much. It's great to be here. First off, by way of apology, I was on a plane yesterday, my ear got plugged, so if I'm crazy loud, it's just that I'm really passionate about it and I can't hear myself. So let me just, if it's okay, I just wanted to quickly level set. Can I just get a show of hands, because I would love to get a sense of the audience. How many of you here are students? Great. And how many of you would consider yourselves sort of impact investing practitioners? Great. And how many of you are here because you've heard so much hype about impact investing and you can't quite figure out what it is and want to know more? Okay. All right, great. So my other caveat, besides having a plugged ear, is I may or may not say anything that relates to any of my slides, and probably not in the right order. So I was mostly asked to talk about, I think what we want to address here, first of all, is kind of what is impact investing? How is it really real as an investment opportunity? And what's needed to make it actually get to scale? So, I would say the first thing that I think impact investing really needs as a field, and I think the hands that went up saying, not sure what this is, but we know it's talked about all the time, is I think we really need a lot more clarity. Now, I think that far too many impact investing conferences spend far too much time talking about a debate over what impact investing is and what the definition is, so I'm not going to do that. All I would say is that from our perspective, the impact investing world is this sort of broad, big tent. And that, for better or worse, it encompasses everything from the sort of cots on one side of the tent that I think are really about incredibly innovative, strategic, catalytic philanthropy that is starting to leverage investment-like tools and structures. On over to the other side of very traditional investing that is looking incredibly critically and rigorously at risk and return. And the thing that unifies all of them is that whether you're on the sort of mission-first catalytic philanthropy side or on the how do I get the best long-term risk and return for my investment, what keeps us under this one tent is that we fundamentally believe that concerns for the environment, for social issues, for governance, is all part of what we should be doing whenever we deploy a dollar anywhere, whether it's philanthropically or in a fiduciary vehicle. So I think that if you just kind of get that first, I think that that's important. I think within that, all of us need to kind of be clear as, to paraphrase, and I'm terrible with sports analogies, so I'll probably butcher it, but, Bill Bradley, when he was a ball player, was, was it Bill Bradley or was it Bobby Orr? Anyway, well, it's a combination of Bobby Orr skates where the puck's gonna be, and Bill Bradley's having that sixth sense of where you are on the court, right? So
I think it's Wayne Gretzky, actually.
What? Okay.
It's okay.
So now anyone can say anything about sports, and you'll be smarter than someone who's already said something about sports here today. Anyway, I think we just need to have a really good sense of where you are, both so that you're clear as to what your own investment goals and objectives are, and if you're dealing with a client, an investor, or an investment opportunity, or an entrepreneur, you're really clear what is the impact that you want to get out of this investment, what is the return that you want to get out of the investment, what's the risk profile, what's the duration, what's the liquidity. So Morgan Stanley, so last year we launched the Institute for Sustainable Investing. And again, many people say that's a really weird sentence to have Wall Street Bank, Morgan Stanley, and the words sustainable investing kind of in the same sentence. What's that about? So James Gorman, our CEO, actually launched the Institute at Columbia Business School. And what he really said, I think, is very reflective of us not knowing sort of where we are on the court or the ice or whatever the right sports analogy is, which is that we're over kind of on this side of the tent, which is we are very clear that we are about, we think about who are our clients. Our clients are people who fundamentally are coming to Morgan Stanley because they want us to be the best efficient allocators and investors of their capital for them, and that first and foremost, they're coming to us as a financial proposition. And so we need to be looking at impact investing on the side of saying, how do you use all of your impact considerations to really enhance the investing that you're doing from a commercial perspective? So we fundamentally actually believe that thinking about ESG factors is frankly great investing. All right, so if, for example, you're a company that today relies on, if you're part of your fundamental business model, if your company relies on the free or near free abundant supply of clean water as an input to your manufacturing processes, and your business model relies on the free or near free disposal of wastewater afterwards, you can be pretty sure whether or not you care about the environment that that's not going to be the same cost structure that you're going to face in 5 or 10 years. If you think about the year 2050, right, the planet's going to have more than 9 billion people on it. So we were over 7 today. So that's a huge increase in people on the planet. And there's an even huger increase expected in the amount of food, water, energy that those people are going to need, not to mention healthcare, education, and all these other services. And so again, you can be either very sort of worried about that and say, oh, good Lord, the world is going to implode. What are we going to do? Or you can say, you know what? If you're smart about it, that's actually a huge opportunity because we have to figure out not just how to create more, resources, but also how to be incredibly innovative so that we're more efficient with them, so that we're using them better, so that we're stewarding them better. And at the end of the day, that's not about everybody use less, because for better or worse, we know that human beings kind of aren't built that way. But it is about how do we do things smarter and how do we create opportunities. And the reason that we think this is not a charitable consideration, but actually a business one, is if you look at all of those opportunities put together, in the year 2050, things like water purification, infrastructure needs, additional education, whatnot, all of that actually is not going to be a philanthropic thing. It's going to actually be 4.5% of world GDP in 2050. So if you're an investor and you want to ignore 4.5% of GDP in 2050, be our guest, but that's probably not a good financial decision. And again, just to be clear, that's not 4.5% of GDP growth in 2050, it's 4.5% of global GDP is going to be meeting these things that today people consider sustainability concerns. So that's kind of part of why we think this is important, and we think it's a business opportunity and a business imperative. And to the point of the panel, I think what do we need to really get there? We think that one of the things you need to get there is really scale, right? If you think about the scale of philanthropy is amazing, and it's dwarfed by the amount of money that sloshes through the capital markets every single day. And so what we're trying to do at the Institute for Sustainable Investing is figure out how do you preserve the incredibly precious resource of philanthropic capital for what philanthropy can only do, and how do you then leverage in economically rational ways what the private sector capital could do, which is add speed, add scale. So we'll talk a little bit about some of the products. I think green bonds is one topic that I'm sure that Manuel is probably going to be talking about, and then we'll talk more on the panel. But just to give you an example, how many people are familiar with green bonds? Okay, so we got like a third half of the group. Just really briefly, green bonds was something that what year are we in now? 14, 13, 14. So in 2012 was a couple $100 million globally, cumulatively for the entire year. 2013 was sort of the breakout year where you had the IFC issue $1 billion green bond, and that really sort of was the shot that kind of really started the race. So 2013 ended up being a $10 billion market for green bonds, and this year we're on track to being over a $40 billion market for green bonds. What a green bond is basically an issuer like the IFC, or like a corporation. Anyone who basically issues debt in the capital market says, okay, I'm going to go ahead and issue debt. It's going to walk and talk and price and look just like any other debt that I issue. So you as an investor know exactly what you're buying. So for the IFC, it was 3-year AAA rated paper with IFC credit. Everyone understood it. They could buy it like that, just the way they do any other bond. And in addition, the issuer says, this $1 billion is going to be only going to be going to projects that are designated as green by the following criteria. So what it gives you is suddenly it gives green or environmentally concerned or socially concerned investors an opportunity to say, that's the thing I want to buy. And I don't need to go through 6 months of additional due diligence to understand it all, because I know how to buy that every single day in the market. And that I think has been one of the things that's led to be such a rapidly growing market. So I think we need a lot more product innovation around things like that. And then finally, I think we really think a lot about sort of what do we need to do to build the field. I think the fact that you're here, the fact that this conference is happening is a big part of that. I think as Bruce mentioned, those of you who are millennials, that you are absolutely going to be the drivers of this, both as the asset owners of your own wealth, your family's wealth, but also as what you're doing for your professions. We have seen sort of staggering interest in people wanting to come into the field, really combining the best of business acumen with the best of sustainability, passion, and considerations, and metrics. And we were really excited that actually Seema, who's here, should stand up, was actually one of the inaugural class of the Columbia Business School Morgan Stanley Sustainable Investing Fellows, and she worked with Morgan Stanley last summer, and we are going to be continuing that program, so any Columbia students in the audience should apply to that. But we've also done a contest around sustainable investing to really get business school students around the world to say, what do we do that is actually not just a groovy social enterprise competition idea, because we've all seen lots of those, and those are great, but how do we actually build scalable financial market rate expectation returning vehicles that we can see grow dramatically? So Let me just see if there's anything in the slides that I probably really should have told you, and then I will sit down. That's who I am. This is the contribution from our lawyers. So there might even be a second page. Oh, there used to be a second page of it. So you got the short version. So anything I said, don't hold me accountable for. The sustainable market is really big, as you know. I mean, already today in the United States, it's about $1 in $9 managed professionally actually has some sort of sustainable, responsible commitment. But frankly, we're way behind Europe, which means there's a huge amount of opportunity to grow, and there's huge opportunity to grow in Asia. This is the U.S. market. Again, the CAGR is crazy, right? So it's clearly you're seeing this is not just asset growth. This is an increased commitment of more and more asset owners to think about this. This is the institute that we've founded. These are, in probably too small to read letters, are pretty impressive board members. You know, everything from a Doug Hodge, who's CEO of PIMCO, to David Gergen, counselor to multiple presidents of both parties, to Luther Reagan, head of the Global Impact Investing Network. So we've got this really large group of folks who are really holding us accountable, and James Gorman, our CEO, chairs it. This is just to show that, again, this is not a niche thing that we think is a cute little fad, flash in the pan. It's really something where we're seeing actual transactions, billions of dollars of transactions that we're doing together with our investment banking and capital markets team. This is, again, just to show you that similar to what Melissa and Bruce have already said, so I won't go into in real detail, but we're seeing huge interest trends growing in a really secular way. The next gens we've talked about a lot, the transfer of wealth, but also foundations. I'll just take 2 seconds. We're increasingly seeing foundations who are saying, you know what, for the entirety of our history as a foundation, we've had this sort of wall between the 5% that we give away programmatically and that we think about mission first, mission only, mission last, and then the 95% that has this wall and no one's allowed to talk to the investment officers because their job is to preserve the endowment to make sure we have that 5% to give away every year. We're increasingly starting to see foundations saying, wait a minute, at a minimum I need to know, is there stuff that I'm investing in that is actually diametrically opposed to what I'm grant making for? And if that's the case, at some point that sort of cognitive dissonance becomes a form of, becomes too high to tolerate. And so at a minimum I need to know what I own, which oftentimes people don't necessarily know what they own, to monitor what I own, to possibly screen out what I don't want to own, and to start to think about proactively what can I own that actually reinforces my mission as opposed to just funds my mission. This is how we think about it. We call it, since we're way over here on the tent, if I can do this without falling off the stage, we talk about investing with impact. Basically to say, we include impact investing as a strategic category within that, but we believe that on the public market, public equity, public debt side, there's a lot of ways you can remain a hard-hearted, cold-blooded, analytical, wonderful, best-in-class, purely economics investor and integrate values into your investment theses, and that's Zurich. So I'm going to stop there, and happy to do questions once we get into discussion. Thanks.
Thanks, Audrey. That's great. Okay, I'm Manuel Lewin, Head of Responsible Investing at Zurich Insurance Company. He oversees the implementation of Zurich's responsible investment strategy for the company's $200 billion portfolio. Please join me in welcoming Manuel.
Well, thank you, Bruce, and thank you to the folks at Columbia for having me here today. It's really a pleasure to be here, particularly in a room full like this with people standing in the back of the room. I don't know if this is a tactic to keep the room small to create that effect, but it's definitely good to see all this interest. Just to alert you, Bruce, I'm probably also going to take all my full 10 minutes to speak. I hope that's okay. And what I want to talk about is really give the institutional investor perspective on the topic of impact investing. So I'm going to talk a little bit about what responsible investment means to Zurich, where impact investing fits within that picture, and particularly where we see the market for impact investments today. And the key message that I want to leave you with here today is that it's extremely important as an investor, and as Audrey has already alluded to have a very clear objective, a very clear strategy, and a strategy that is embedded in your overall investment approach if you really want to think about responsible investment and impact investment. Without that, I think it's really hard to overcome some of the challenges associated with impact investing, and I'm going to talk a little bit more about these later on. But before I start, let me just talk a little bit about Zurich. I'm sure not everyone here in the room is familiar with my institution. So essentially, we're a large global insurance company. We offer property, casualty, life insurance products to customers in over 170 countries. So a truly global company. From an investment management perspective, one thing that maybe sets us a little bit apart from other large insurance companies is that we actually don't run a third-party asset management business. We don't sell investment product. The $200 billion portfolio that we manage is essentially the premium dollars that we collect from writing insurance business. And in conducting that business, we are guided by our code of conduct. We call it the Zurich Basics. And what that code of conduct tells us is that to be successful as a company, we need to create sustainable value. Now, what is a nice word? What does that mean? It means a number of things for us. It means that we need to create value not just for our shareholders, not just for our customers or policyholders, not just for ourselves as employees, but really also for society, for the communities in which we live and operate, for our environment. It also means that we need to deal proactively with environmental, social, and governance issues. And last but not least, it means that we need to focus on long-term success over short-term gain. So for us, this is really the basis for thinking about our responsibility as a corporate. And that implies that corporate responsibility for us is much more than the work that our foundation does and our community investment opportunities. These are great. These are very important to us, but we want to think about corporate responsibility in a much more strategic way. For us, it is about how we can lever our core skills in underwriting risk and managing that risk and in managing our invested assets to really create that sustainable value. And that's why we need to integrate our corporate responsibility into our core business processes, into the way we run our business, into our strategy. And the three areas we focus on to do that is managing our assets responsibly, reflecting corporate responsibility in our business transactions, and we've built a very specific program around flood resilience. Now, from an investment management perspective, what we have set out to do is to manage our overall portfolio of $200 billion in a way that allows us to do well, to be that hard-nosed investor and generate superior risk-adjusted returns relative to our insurance liabilities, which is what a lot of people expect from us, but at the same time manage the assets in a way that allows us to do good and to create value that accrues to a broader set of stakeholders and value that may not be measured in dollars and cents, but maybe in tons of CO2 avoided or a number of underserved people reached or other types of metrics. And to achieve that objective, we are really doing three things. The first one is integrating environmental, social, and governance factors or issues into our investment process. This is not about ethical screening or exclusion or not investing into tobacco and alcohol. This is about economic realities. This is about the fact that things like climate change, resource scarcity, social inequality, etc., do impact the risk and the return associated with the things in which we invest, whether that's an equity security, a bond, a piece of real estate, or a private equity investment. The second thing that we do is try and identify investment opportunities that in a very targeted and tangible way create that more non-financial value. And of course, that's impact investing and what we're here to talk about today. And just for completeness, the last element in our approach is about working together with our peers, with our asset managers, with other industry participants to really advance responsible investment practices together. I think all of this is only going to make a difference if it becomes mainstream. And that's something that's really important to us. But let's focus on impact investing, since this is the topic here today. And at Zurich, we think about impact investing really along three dimensions or three key characteristics. The first one of which is intentionality, and that's something that Bruce has mentioned in the introduction. I think this is very important. Every investment is impactful. every investment creates jobs somewhere. You can look into your portfolio. You probably hold a share of Walmart stock in there. That's maybe, you could argue that this helps low-income families to access a broader range of affordable product, and that's definitely a good thing. But when we think about impact, we don't want to think of it as kind of, a side effect of what we happen to hold in our portfolio. It is really about being intentional in the type of impact you want to have. Essentially, you're making impact part of your investment objective. And it follows straight on from that that you should measure it. If you have an objective, if we have financial objectives, well, then we look at what's the risk, what's the return, have we achieved those financial objectives? And in the very same way, we ought to at least try to measure whether we've achieved our non-financial objectives. And last, but certainly not least, for us it's also about profitability. We're not a charity. We're not in the business of giving money away. We're not philanthropists. For us, the most important thing is to be able and be here for our customers when they need us to pay out claims. If you take out homeowners insurance with Zurich, your house burns down, you come, you file a claim, and I tell you, you know what, I'm only going to pay you 90% of the insured value, but you know what, I've had some really great impact in Africa. I'm not sure that's going to fly, right? So we need to be able and do this in a way that allows us to generate a return that we're comfortable compensates for our risk. So what do we do specifically in the area of impact investment? So one of the things I want to talk a little bit about is green bonds, and Audrey already alerted you to that. This is an area where we have been very active so far. We've committed to invest up to $2 billion in green bonds. We've already invested about half a billion, and I just want to give you a concrete example of what a green bond does. Earlier this year, Bank of America issued a green bond, and you can log on to their webpage and you will see a list of all the projects that have received funding through that green bond. An example of that would be a project in California where they retrofit streetlights, take away old inefficient light bulbs, replace them with LED bulbs, and that will result in an estimated 47,000 tons of CO2 emissions avoided every year. Other examples are wind farms and solar farms in Oklahoma that will, again, every year avoid an estimated CO2 emissions of 175,000 tons. And taken together, all of the projects that have received funding through that bond will avoid over 450,000 tons of CO2 emissions. And just to give you an idea, that's equivalent to taking about 60,000 cars off the street. And what you can see here on the screen is one of the biggest parking lots in the world. It holds 12,000 cars. So that's 5 times the amount of cars you can see here on the screen. That's making a real difference. So green bonds for us is a great opportunity to invest with a specific objective to mitigate climate change. It allows us to measure what the impact is that we're having, and it allows us to invest at a return that we feel comfortable compensates us for the risk. Now, we're also doing other things. It's not the only thing we do. We've recently started becoming active in the private equity space. We've made a first commitment to a manager that focuses on microinsurance and microfinance in Africa and Asia. We've invested with a private equity manager that focuses on environmental technologies, and we're continuously looking at more opportunities. We're doing a lot of work around development impact bonds, around sustainable infrastructure, and hopefully some good investments will come out of that with time. But I think the fact of the matter is that the market for impact investment looks a bit like this. It's a jungle, right? There's a million plants and animals out there, and you're not quite sure which ones heal and which ones sting. And that's a challenge. And I think from an overall market perspective, it is a challenge that there is no generally accepted definition of impact investing. And I disagree a little bit with Audrey. You don't want to discuss endlessly about what this is. But you have people who think of impact investing as, an ethically screened listed equity fund. That's an impact investment. You have other people who say, no, to be an impact investor, you need to provide venture capital to social entrepreneur, and everything else is not really impactful. And then, of course, there is, a million things in between, from microfinance, SME financing, both equity and debt and infrastructure and green bonds. There's literally a ton of things that you can do, and this can be daunting for an investor who is not, who hasn't grown up in impact investing or in sustainable investments. Scale is an issue. Fully agree with Audrey on that one. Delivering investable scale, particularly for large institutional investors such as ourselves, but also standardization. I don't think there is necessarily a lack of impact investment opportunities out there, but there's definitely not enough impact investment opportunities in specific segments of the market that would allow a large investor such as ourselves to really build a mandate around it, and that can be challenging. And last but not least, impact measurement is really tough. It's really, really difficult to do. And today, at best, we see people measuring output rather than impact or outcomes, right? So this is difficult, and it's at this point hard to try and kind of aggregate across a portfolio the impact that you're having. And specifically from the perspective of the investor, I think if you want to become active in impact investing, the first challenge is to create the organizational buy-in, to convince people within the organization. And quite frankly, the very term impact investing raises a lot of red flags, and people have all kinds of wild ideas what impact investing is. And the first association is typically with something that trade-off risk for return that we shouldn't look at. Even if you can convince people, it can be challenging to define what are your impact objectives, particularly if you're a very large and very diverse institution, such as, for instance, ourselves. And even if you can do that, you still need to come up with a specific investment strategy that embeds impact investing within your overall investment approach, and you need to find the right skills to actually manage a portfolio of impact investments. So I think there's actually a lot of challenges out there if you really want to do this, and by no means are they insurmountable. But to come back to my key message, I think you will only muster the energy and the resources to overcome these challenges if you really have a very clear objective, if you know what you're doing, why you're doing it, and if you're making it an integral part of your overall investment approach. And I'm going to stop here and hope that this has given a little bit of food for thought for our Q&A.
That was terrific. Thank you very much. Okay, I think that was a good introduction to the subject and from a couple different perspectives. We want to just open it to Q&A to the audience. Seema has the microphone. It's a small room, but I think the mic helps. In terms of questions, just a couple ground rules. Please keep your question brief. Questions only. Please, no statements. I want to give everybody a chance to participate. And when you ask questions, just, if you don't mind, your name and organization would be helpful as well. So, please, questions.
Hi, my name is Zara Hassan Ali. I've been responsible for monitoring and evaluation or performance measurement for sustainability projects with the IFC for the last 4 of the 10 years I've been with the World Bank Group. So my question is directed towards Zurich Insurance Company. So a couple of questions. One on drought resilience. Please excuse my ignorance, but I was curious as to whether you've looked at the ARC model, ARC, and I think that that's a great model to scale up drought resilience and even extend that towards disaster response and management. And the second around the challenge of sustainability and measures of sustainability, 2 ideas that we were piloting at IFC that might be helpful if you've not already considered them. One is the idea of a sustainability framework for projects. And this is something that we developed in Africa and have piloted across the continent. In other words, it's a framework that ensures that once IFC projects exit, we've built into place the human as well as the systems capacity. And secondly, around the indicators and consistent measurement across regions has been a struggle for global institutions or multilateral institutions, and they have actually developed a bunch of best practice metrics that I'd be happy to speak to, at some point and share if it can be of any help to the panel.
Sure. I'm going to try and turn this into a question. I'm actually not familiar with the ARC model, but I'm certainly interested to learn more about that. So maybe we can just exchange business cards at the end of the session. We're very much aware of really the great groundbreaking and leading work that a lot of the supranational institutions such as IFC are doing, and I know that, for instance, at IFC they have developed something that's called the Development Outcome Tracking System (DOTS) that is consistently applied to every project. At least that's my understanding. And I know that these kind of institutions have also been very much involved in the establishment of impact reporting standards. So I think someone before, I'm not quite sure who mentioned, I think it was you, Audrey, you mentioned a person from the GIN, the Global Impact Investor Network. So they developed an impact reporting standard called IRIS. And I know that folks like IFC and also other supranational institutions have been very much involved in trying to develop these standards. And I think that's a great first step. I think one of the challenges is that even though these kind of standards start to emerge, we're not seeing them necessarily applied. And so I think green bonds is an interesting example. We are working very closely with a group of issuers in the supranational space, specifically the World Bank, IFC, and a number of others, to try and develop impact reporting standards for green bonds. Now, it is incredibly challenging, even amongst this very small group of experts, to actually agree on how do you come up with your CO2 equivalent. Right? There's lots of assumptions that go into that, and it's not at all easy to do. So there's not even in something that's kind of as narrowly defined as a green bond, with a very narrow group of actors, you can come up with that standard. So if you look at this very diverse universe that is impact investing, I think we're still far away from a situation where we can take what our private equity manager dealing with environmental technology does to what a World Bank does issuing a green bond, to get an understanding of what happens at a portfolio level. But I'd be more than happy to talk to you afterwards and learn more about some of the things that you mentioned.
I think we have another one back here.
Hi, Lindsay Narcott from Impact Assets. I'm curious, from each of your perspective, what additional research you think would be really helpful to move the field forward, whether that's for you as an existing practitioner or to help other people sort of get over the hurdle to understand what the market looks like and feel comfortable entering it.
Yeah, I think from a research perspective, what's helpful for us is being able to kind of get ahead of client demand and understanding what are the issues that clients are really interested in. For example, we've had a ton of interest recently in water specifically. And so, my team is kind of scampering around trying to figure out what they think the best way to approach water is. And so it's caused a lot of really interesting internal debates amongst both people on the research side and on the investment side, like what actually makes the most sense from both an investment standpoint and an impact standpoint. Like, what's the best way to play for our clients specifically? Because, we're generally dealing with clients who, can have probably a higher appetite for risk than more traditional commercial investors do. And so in those instances, we have to figure out that we understand an issue well enough to figure out what do we think makes the most sense for our clients and how do we kind of get ahead of that demand. So from my perspective, it's just helpful to understand what are the issues that I think are really, resonating strongly with millennials, with Gen 2, because again, they're often ones that are kind of pushing these conversations forward within their families.
I would just add to that I think one of the biggest concerns, or something that can make people pause before embarking on an impact investing trajectory, is the concern about whether they're going to take a haircut financially. So I think the more that there can be research around track record of investments that have been made with some intentional impact and how those have performed, relative to sort of vanilla, if you will, investments, I think is very important. I think there actually is a lot of an increasing number of research out there already that's showing the value proposition provided by ESG as a part of business management, but I think there can also be more around track record. And I think, very much agree with Manuel also that I think we need to have more research around what are the relevant and important and kind of significant impact measurements that really make a difference from both the impact and the financial side, so people are really tracking the right things. I think a colleague once told me about a private equity fund that they had looked at where there had been an incentive put on about they were trying to track social impact, and so this fund manager was told to think about, in the healthcare space, number of hospital beds that were created as a result of this investment, and then on the back end you see that they ended up having warehouses full of hospital beds because that was an impact measurement that they had to get to, right? As opposed to like lives saved, patients served, or whatever the right outcome was.
I could probably add a lot of things to that list, but maybe just three that I would mention here. I guess more on the kind of academic side. I think one interesting question is one that I think Audrey implicitly brought up before, is this notion of, okay, if you're kind of an investor, you're managing a mainstream portfolio and you're trying to do to integrate all these ESG factors, you're doing all that kind of the sustainable investing piece. Does that actually lead to better environmental and social outcomes? We're pretty sure that it will help us lead to better risk-adjusted returns. But what does it actually really mean for economic social outcomes? That's a question that I've had many times, and I think is one that do you want to look at these type of investments at impact investing as well? Can you do this with intentionality? I think you can only find an answer to that question if you understand how that translates into environmental social outcomes. Another question, I think, another debate that often comes up in the field of impact investing is it's often associated more with kind of grassroots types of activities, right? Kind of the bottom of the pyramid, access to financial services at the bottom of the pyramid, things like that. And I think there's kind of a good understanding of how that translates in development outcomes. But when we're talking about the more scalable spectrum of the market, when we're talking about things like providing growth capital to companies that try to offer products and services to kind of emerging consumers that exit the bottom of the pyramid and enter maybe the middle of the pyramid, what developmental outcome does that have? And there's kind of an implicit notion that it has to be bottom of the pyramid. But I think it's also important, to provide scale once you move a little bit up. But what that impact really is, what the developmental benefits of that really are. It's not something at least it's not something that I've come across. And maybe one last thing that I would mention, more applied, more on the market side, I've kind of always dreamt of having, a market map, something that kind of maps out what does impact investing universe looks like. And that's just not something that I've ever come across in a complete way. So, for all kind of the consultants in here who advise companies on impact investing, if you can provide that would certainly be helpful for people.
And I could just add, from an educational perspective, what we need is more business school cases. We need more case studies of what's going on in the sector. And people think case studies means a description of this is what somebody did and so on. That's not a case study. Case study is actually a data-driven analysis of a problem that needs to be solved. And if you go, for example, to HBS Publishing, Harvard Business School Publishing, which is a primary repository of cases for business schools. Anybody can do that, by the way. You can look online and you type in impact investing and see what comes up. The list of cases is depressingly short. So we need academic institutions, business schools across the country, globally, to be designing and writing more of these cases.
I would just add, too, also on that note, there's this whole movement right now amongst practitioners on the direct investing side to share term sheets, something as simple as that, and just to basically provide more transparency into deal structures, and so people can learn from people's mistakes and understand how certain challenges on the impact side were maybe overcome or surmounted. I think the work we do on the direct investing side tends to be hairier. I've described it before to friends as like trying to climb a mountain with like a backpack of bricks on, because you deal with non-traditional challenges. The work that you do tends to be much more complicated. There's a lot of nuance that needs to be taken into account, and you're thinking about factors that are just not financial. They're not solely financial. You're thinking about environmental factors, social factors, and so when you put all that together, sometimes what you do ends up being pretty non-traditional. So I think having there be more transparency into how deals get done is also really important, because we can all learn from that. And then, again, the scale issue that we're all talking about can be addressed as well.
Good morning. My name is Lisa Renee Brown. I'm on the International Planning Committee. We're building a graduate university in West Africa in Ghana. And I'm wondering, as I sit here, having this great panel of advisors. How can we look at that to make that a sustainable project? Like what sort of things that would make it interesting to your clients or as an investment possibility? How do you make a university a sustainable investment for someone who might be interested, if it's possible?
When you get the answer, let us know. At Columbia, we're working on that. We're working on that very problem. First of all, I commend you on doing this in Ghana and West Africa. I often get very approached frequently at Columbia, where a nonprofit institution in a traditionally nonprofit sector says, "Wait a minute, I hear all about impact investing. I hear about sustainable enterprise, social enterprise. How do I do it? How do I suddenly become financially sustainable?" And I think the answer is there's no magic bullet, obviously. I think what the sector is finding is that there are an increasing acceptance of applying business tools and management skills to running nonprofits. That's not the same thing as suddenly we can finance ourselves, but you can incorporate many of these tools. And I would say the business schools, despite my joke about being long-term sustainable, probably are somewhat in the forefront of trying to use some of those tools. Thoughts from the rest of the panel?
I mean, this is not my area of expertise necessarily, but what I would say maybe to follow up on some of the comments that Bruce has made is that just the mere fact that something is sustainable and maybe creates a sustainable outcome or a positive impact does not automatically make it an impact investment. Right? There needs to be an underlying investment thesis. If you're making an investment, you want your capital back, and not just that, you want a return on it, right? And underlying profitability, underlying cash flows need to drive that. I think there are innovative ways to think about how the not-for-profit sector can maybe lever capital that is actually return seeking, and there's ways to blend different sources of capital, with donors, etc. If that's something you're interested in, is actually we've done some research on that question. We've worked together with a large international NGO to kind of develop a little bit of a thought framework to think about this question. But I think the underlying reality is that in the end someone needs to pick up the bill if you want to pay an investor back, and so the business model needs to deliver that.
Hi everyone, thanks for speaking with us this morning. My name is Ida Gurma, and I work with Arabella Advisors. We're a philanthropy consultancy with a growing impact investing advisory line of business. And so I think the interest in impact investing within philanthropy is sort of very clear to us all. We see there's a clear value there for philanthropists, and especially for the foundations, family foundations, high net worth individuals interested in philanthropy. That's clear. Like impact investing is cool to everyone. But how can we develop interest in impact investing within capital markets at a greater scale? I know that's a big question. And Audrey, you mentioned, the growing percentage of global GDP that's going to be comprised of sustainability concerns, and that's very compelling. But I think I'm a millennial, so I'll try to speak for millennials here. Most everything else seems like very old school, very anti-progressive, and we understand that impact investing is a jungle, like you said. The vehicles are being developed, the whole processes are still being developed, but I think for us, we want to get away from anything that's sort of overtly anti-sustainable, and that's like a clear value, and so I'm sort of trying to figure out how can that be spread. How do we motivate people to possibly defer larger short-term returns in the interest of supporting, a sustainable economy in the long run? So from your experiences, what conversations, what points really resonate, really click in helping that along? Thank you.
I mean, I think, you definitely are the voice of the millennials with that. We are seeing that so clearly that, most of the stuff that capital markets do is really boring to millennials, right? And I think there's a distrust of large organizations, and large institutions, and large companies, and you want to see sort of really radical, proactive things. I think. Look, I think it is, that's exactly the challenge that we have to get to, right? Which is because I think we need to do both sides. We want to be incredibly rigorous about the development of new impact investing labeled products so that they don't disappoint, right? Because I think the worst thing that could happen is you see a large migration of capital, either small amounts by many, many, many people, or large amounts by sort of leading institutions who go into an investment product or vehicle thinking that they're going to match market returns, and save the world all in their this one easy capital market instrument, and then they find that there's a tracking error and that they would have done marginally better or a lot better in a sort of a regular product. So I think the first thing is that we need to be incredibly focused on driving innovation around that, but we also need to be very, very cautious about it. I think that it is, you're right, I think that there's, I do believe, first of all, two things. One is I do believe it's important to look at some of the products that your generation may think are boring, right? Because if you think about, if you can make large traditional energy companies today, 1%, more, greener in terms of their carbon emissions or whatnot, that probably, as of today, dwarfs the carbon impact that you would have of, pretty much all the solar companies or, wind companies kind of put together. However, and so I think you can't ignore that. So I think that where large-scale capital is comfortable doing those kinds of more traditional things, that's very important. It needs to be coupled, obviously, with a proactive driving those new vehicles so that the alternative energy companies, the sustainable companies, really can get up to that scale and really, really drive. And so I think that it's a lot about developing more focus on the innovative high growth models that really can become great investable opportunities. And as Manuel said, looking at the companies that are really driving high quality job creation, looking in markets that are, they're emerging markets that are going to have higher than average growth rates, and really making sure that the companies and the jobs that are created there are going to be high quality jobs. And so you can differ, and I think that your generation is going to be, completely the game changer in driving those dollars more and more to the proactive ones.
Yeah, if I can add to that, I want to give two answers. One from the perspective of a large institution, and then maybe one more from my personal individual perspective. So I think from the perspective of a large institution, again, I think it's really important for companies to think about corporate responsibility in new terms. I think there's an old model of corporate responsibility where there is a very clear separation between what you do on a day-to-day business basis, and then you have your philanthropic activities, you have your community investment activities, you have your foundation on the other side. And it's actually something that I think for historical reason is more prevalent as a model here in the US. I think in Europe it's different, it's more blended. And so I think one challenge is for organizations to overcome that and to think much more strategically about what their role is in providing and using their core skills and doing what they're good at and coupling that with trying to achieve sustainable outcomes. And I think probably as hopefully there'll be a generational change in the companies here at one point, maybe the perspective of the millennials will translate into that, but I think the jury is still out in that. And I want to maybe now come into the personal perspective, also introduce a little dose of reality here. I think I barely qualify as a millennial. You said back to the 80s, right?
1980. Yeah.
1980. Okay, so I'm still a millennial, right? So I can speak for the millennials as well, right? I'm surprised at the 64% figure. If I look, I think we're looking at this room. There's a lot of self-selection in this room. If I look at it a lot what my friends do, if I look how they invest their money, they don't do impact investment. And I think in the end, we're concerned about whether our pensions are going to be safe in 30 years' time, right? We're not, if someone comes to we can do this really crazy innovative investment, when the rubber meets the road, when you need to put down the money, are you going to do it? So I think it's nice to have those aspirations, but I think we're still a little bit away from that. I think the challenge is, you may have all these ideas. You go to your financial advisor, and he doesn't know much about impact investing, right? He's not going to be able to offer you a good opportunity that you can, as a retail investor, where you can do something. So So I think a lot of education is still needed, and we need to work on both. We need to work on the demand side and also on the supply side to provide the investable product that at scale. And that's why it's so important to make this mainstream, right? Because only if it's really mainstream can you get this to scale. So I just wanted to provide that perspective as well.
I just want to add one quick point to that. I think there's a troubling disconnect between what people say and what they do, and that's partly perhaps why those numbers do look very high. A simple example, how many people in this room would encourage people to smoke more? Probably not a lot of hands up. But if you looked at where your assets are, I guarantee you some section of this room has money in funds that hold tobacco shares, that you just do. And so people say this is what they support, this is what they believe, but when it comes to their investing, they don't often translate it very well. And I think that can be troubling for millennials and younger people who want to see people's actions and words line up.
Good morning. My name is Manuel. I'm a student at Hunter College. I have a question on social stock exchanges. What do you think about them? Do you think there's a need for them? They're not very good, or there's not that much liquidity as of now. Exchanges on which you can trade, investments like that or equity in impact.
I was going to say, what's a social stock exchange? I'm familiar with the ones that are out there, but really, what's a social stock exchange, right? What makes a social stock exchange different from another stock exchange, and does it, what are the criteria to be on one? In a sense, I think it's great what these social stock exchanges are trying to achieve. Trying to provide a platform to list certain impact investments, start creating liquidity for some of these more innovative things. But in a sense, I almost kind of wonder, shouldn't the real question be what does it take to make the New York Stock Exchange a sustainable stock exchange, right? And so for me, it kind of goes a bit more in the direction of disclosure requirements, data requirements. In the end, I think what is really important is providing transparency so that investors can make informed decisions about what is sustainable, what is not, and what does align with their view of sustainable. Is there a need for specific specialized social stock exchanges within that? Maybe I don't know. But my key question would be why not make the London and the New York and the Zurich and the Paris Stock Exchange sustainable exchanges?
Good morning. Thank you all for coming today. My name is Simone Castillo, and I'm a CBS EMBA class of 2015. To piggyback on the comment here from someone from Arabella, I would just like to ask all of you, what are you guys doing internally to address the shift, possibly even in the culture, to address the millennial interest in impact investing, or even your current client interest in impact investing? And also, what are you doing to seek out talent that would be able to drive that as well?
Frankly, millennials is really been a big topic that we've been focusing on. As I said, I think that we definitely are seeing that from the high net worth clients, from the families, you're definitely seeing those generational shifts. We actually had a conference with sort of next gen where the sort of 60, 70, 80 something matriarchs came with their 20, 30 something kids, and the kids very clearly said, we're not keeping our money invested the way Daddy did. Frankly, it was one of the things that we want to work on is actually increasing the diversity of our own financial advisors, who currently don't reflect the demographic that the millennials have, and necessarily the demographic that the millennials want to have as their financial advisors. But I think also very much kind of combining this with what Bruce was just saying is we also have to make it easier, right? Because again, everybody has day jobs, right? Except for the few people who are only professional investors. But when we talk about retail clients and millennials, and so one of the things that we did, for example, is we actually recently launched 2 sustainable portfolios for our wealth management clients. Because I think one of the problems has been that is if you come to your financial advisor and say, okay, you know, Fred, I'm really passionate about this, and I want to make sure that my investments align. You know, you probably have to first, in many cases, get through the conversation where Fred, our mythical, you know, advisor of any company, says, "Oh dear, you know, let's make sure you have enough for college for your kids, and you know, why don't you take your philanthropy over there and do your good things over there, but let me manage your money because that's what I know how to do." What's been really exciting for us is that since we launched, we actually to get around that, we basically said, look, we have to be able to put in front of Fred and Fred's clients of today and tomorrow investment opportunities that Fred actually thinks are sound investments, right? So we've actually, in 2012, we launched what we call the Investing with Impact platform, where we actually have currently over 120 products on there and the way those products that are sustainable, right? The way those products got there was that first and foremost, they had to pass the crusty due diligence that any product has to pass to go on the Morgan Stanley platform. So Fred is assured that, you know, this is a product like any other product. And then it goes through a sort of an additional sustainability kind of screen. So it's great that we now have these products that Fred can choose from. But then, you know, in addition, the issue is then if you supposing you have all your money in a sort of a great sort of broadly diversified multi-asset class portfolio or managed sort of traditionally, and then you come and say, okay, I want to take a little bit of money and try the sustainability stuff. If you then kind of just picked like one of those 120 products, kind of like those little games that goes into like the pot of stuffed animals and picks one out, you have no idea how that's going to perform relative to this wonderfully broad asset allocated, this really diversified portfolio. So what we've actually done is we said, look, people really do want this, but they don't want this sort of random kind of one product outlier. They want an approach. And so we're going to continue to build it. One of the things we've done, we just announced about a month ago, is we took the Global Investment Committee, which is our sort of, council of graybeards who figure out what should the asset allocation model be, what are markets doing, what is our opinion of the markets just generally. And we are using those models from the Global Investment Committee. So again, to Manuel's point, sort of doing what we're supposed to do best, and then overlaying that with a sustainability screen. So we now have one all equity portfolio, one balanced portfolio that is a multi-asset class, diversified portfolio that you can sort of say, okay, take 5% of what I have, or 1%, or whatever it is, and sort of put it in that portfolio. And what we really want to do is start building out more and more of those portfolios with different themes, because some people may want sustainability generally, some people may be really passionate about one specific issue or set of issues, and then really start to build the tools that people can start to say, well, how did that well-managed ESG portfolio do relative to the vanilla portfolio? And as you start seeing that, how can you sort of move more and more into that? That's one of the things.
Sorry, I keep adding, right?
Oh, that's great. And
but
when you add, I say, "Oh shoot, that's what I should have said."
But I think it's a really important question. I think one of the benefits, quite frankly, for us, doing impact investments is it's a great instrument to engage our people and to attract talent. It's by no means the only benefit or the driving factor, but it's an important aspect. But I think the even more important part of your question was around culture. If we want to achieve our objective of managing our overall assets, to do well and do good, we're only going to achieve that if we build the right culture within the team to do that, and that's not something you do overnight. This takes years and a long time, and it takes two things. Firstly, it's got to start with top-down support. And we have, we're in the lucky position that our group chief investment officer has been and continues to be, a great champion of not just impact investing, but really this notion of responsible investment. As an initiative, this had, the top-down support of our CEO, of our group executive committee, even of our board of directors, who are all very supportive. And I think that's the starting point. If you don't have that buy-in from the top of your organization, you're never going to be able to create that culture. But then, that's not sufficient. I think equally importantly, you then need to incentivize your people bottom up to actually do it, right? To execute. We need to put our money where our mouth is, and so there's a number of things that we've done there. First of all, we've started putting specific wording into people's individual objectives. So everyone at the beginning of the year, they get a set of individual objectives. They're being evaluated on those at the end of the year, and that will determine their variable compensation components. So we've started to introduce some language for people in investment management as to how they're expected to support our responsible investment activities. We've also started to include responsible investment in the way we define the competencies that it takes to fill a certain position on the job. So every job we have a portfolio manager, an analyst, a regional investment manager comes with a job profile and has a long list of kind of technical competencies that are required to do that role, and that will guide kind of training and development needs. And we've defined what do our people need to know about responsible investment to be able to do that. Now, one of the challenges, we put that in there, we realize, people don't necessarily have those skills, and we're looking for training out there, and it doesn't really exist. So that's another topic for discussion. That's a challenge. And then the last thing that we did is we've kind of appointed in every single team that we have a person, a responsible investment champion, who is kind of responsible to work with the team, support the team bottom up, and these responsible investment activities. And that's been a great tool for engagement, actually. It's been really good to see how people have been excited about taking on these roles. And I'm holding like a monthly call. It's like we have 20 around the globe of these responsible investment champions, and people are engaged. They contribute to these calls. So that it's going both ways. It's a great instrument for engagement, and it's a great tool for execution.
Hi, my name is Tanya. I'm a student at Columbia Business School, but I worked for a number of years at IGNIA. IGNIA is an impact investing venture capital fund based in Mexico. And one of the challenges that we faced is finding the right instruments to invest in all of these investments that we found attractive. And IGNIA is an equity fund, and we ended up investing based on tranches and the completion of certain social milestones that prompted disbursement. And I was wondering what instruments do you use? Do you think there's some that are better than others when it comes to impact investments? And how do you tie in the social and environmental piece into the instrument itself, if at all?
Lisa, do you want to?
Yeah, I would say for us, with all of our direct investments, from the outset, we've established a set of criteria, metrics, and reporting requirements that we think, we want alignment, right, with an investee from the beginning. So we'll make sure that that's explicitly stated from the beginning. That will always be embodied and put into writing in the term sheet. And whether that comes in the form of actual financial covenants, which require them to, basically subject themselves to ongoing monitoring and reporting, similar to their financial covenants, that could be the case. There are also sometimes just conditions to draws, and so we'll tranche the investment, and we'll have that be subject to the completion of certain operational and impact-based milestones. Often there's also a side letter which is completed where a company makes a pledge or a commitment to honor and uphold certain underlying principles, but then in addition to that, there may be monitoring and reporting requirements that they're committing to as well. So there's a bunch of different ways that we approach it. I think it depends on the investment. It depends on the client and their objectives and what they're trying to accomplish. But I think for us, it's always just good to put it in writing and have it be in the credit agreement, in the term sheet, in a side letter, and so that down the road everyone remembers what they've signed up for initially.
Sure. Two things that I would maybe mention. The first one is in determining the right instrument, you got to think about what's the problem you want to solve, underlying, right? And in the end, financial market instruments are tools to allocate risk to those best able to bear it. I think you need to understand both what is the underlying social problem or environmental problem you want to solve, and what's the financial problem you want to solve. How does the risk look like, and who is actually able to bear it? And that will determine the type of structure. And it could be equity, it could be debt, it could be mezzanine, you may need de-risking, it could be structured, it could be a CDO type, it could be a million things. But what it is needs to be firstly driven by what's the problem you're trying to solve, and then of course what do the investors demand, right? And there's no silver bullet. Depends on it depends, really on the investment strategy of the investor. What is their risk-taking capacity? As an insurance company, for instance, we're very much driven by asset liability management. So we're driven by the embedded risk in our liability profile, which is mostly interest rate risk. That's why 85% of our $220 billion is invested in fixed income product, right? So if you're trying to sell something to an insurance company, it's always good to make it fixed income because that's the bulk of what they do. But it really depends who your investor is.
Hi, Shelley Cheong from Forward. I basically run a professional events publication, and what we profile a lot is innovation in financing, investing, funding, and what we, I suppose, have been seeing a lot recently is crowdfunding. And specifically, obviously Title II is currently in play. It's only accredited investments or money from accredited investors. But Title III is starting to probably kick in the next year, hopefully, which obviously opens up a large floodgate of unaccredited investors being involved. And obviously platforms like Mosaic offers opportunities like that. I'm just curious to hear from the panel where you see that fitting into, obviously everyday investors can start getting involved, which I believe is very exciting, but how does that fit into, your investment thesis?
Yeah, no, I think crowdfunding is fascinating. And for us, I think, one of the challenges that we find that we have with a lot of our investors is that we don't have access. A lot of times the products that we want to be in or that we'd like to be in, from both a, financial risk-reward perspective and an impact perspective, just aren't accessible to some of our smaller clients. And so if we can, we'll aggregate to a higher volume and then try to see if we can negotiate something with the manager. But crowdfunding allows us and allows clients, I think, at a really small level to just have a higher level of engagement. And so I think we've got a bunch of clients that are really interested in crowdfunding because they think that it supports this whole idea around like democratization of capital, right? Like, should everyone have access to these kinds of opportunities and these platforms? And I think for us, we will always review a platform or an opportunity for clients, but the problem for us is that there's not necessarily like a lot of transparency beyond some of the platforms. And so what's behind them from an operational perspective and how much diligence they're doing and how much on the execution side, how much confidence we have on the execution side is sort of up in the air. And so while we in principle support them and think that they make sense for a lot of reasons, our challenge is that to some degree there isn't a lot of transparency with relation to what's going on underneath them or behind them.
I'm not an expert in crowdfunding, but I want to two points that I want to make. The first one, so if you look at take crowdfunding, right? The question that we need to ask ourselves as an investor is what type of risk does that expose us to? And in the end, it's retail credit risk, right? We have many ways to get exposure to that risk. We can be active in a mortgage space. We can invest in an equity or a bond of a bank. So the question is crowdfunding an efficient way for us to get access to a certain type of risk? I haven't done the analysis, so I can't give you a yes or no answer. The other thing I would say is that, of course, innovation is great. But innovation for the sake of innovation, again, it needs to solve a problem. Now, in crowdfunding, I can see a problem on the supply kind of side. I'm not sure it solves a problem on the investor side.
I would just add that, again, similar. I think it's a really interesting and clearly very sort of captivating opportunity, especially for entrepreneurs who really need to be able to break through some of the traditional constraints on getting capital for an early stage or a growth stage company. I think it just needs to be done very carefully, right? I mean, direct investing just is more complicated, requires a different level of diligence, and I think that we just all collectively want to make sure that it's being sort of monitored well, that people aren't sort of getting out over their skis on it, right? Because again, I think, I would just say with all of these different experiments and innovations in impact investing, we're all still in that sort of new, stage of the market where the world is kind of new, and any mistake that we make will be with us for decades. It will become these sort of iconic fables of why impact investing doesn't work. And you're only as good as your last famous iconic failure or anybody else's failure. And so, I think it takes, I think we just need to be very cautious to make sure that people are doing something that is in any, whether it's crowdfunding or buying $1 billion worth of a green bond, you should be really aware of your own risk profile, your tolerances, your goals, getting back to the sports metaphor that I butchered of like knowing where you are on the court and where you want to skate to and why you're doing it, and are you picking the right tools, for you, so that we can all kind of drive the field forward with as few sort of, bumps on the road as possible.
We just have to say the word Solyndra to know how one high-profile mistake can almost destroy a whole sector. Don't want to have that in crowdfunding in this sector. I think we have time for one or maybe two very quick questions. Seema.
Hello, good morning. My name is Jaime Calonge. I'm working for the European Investment Fund as part of the European Investment Group, and specifically in the impact investing unit. Last year we launched a Fund of Funds initiative. We mainly invest in funds, in impact investing funds. And I'm really curious to learn a bit more on specifically in the activity of your institution is running in Europe. Basically if you find any sort of a specific challenge in entering such market, European market. Thank you.
Quick comment on Europe. You are European.
I guess I'm the European one on the panel. So I'm not sure whether you're referring to specifically European-based impact fund managers or fund managers who target investments in Europe. I would say what we tend to see, I think in terms of private equity fund managers who would brand themselves as impact investment funds, and not all do that actually make impactful investments. But of those who do, from what we can tell, I think there tends to be increasingly more activity in an emerging market context. The manager may be located in the US or Europe, whether it's a fund or fund or fund, but I think of the underlying activity, we're seeing a bit more emerging market focus. I would say traditionally in the developed world, there is more in the U.S. than in Europe, definitely. And I think one of the driving factors of that is probably a lot of the community development finance activities that you have here, don't have in Europe, and certainly also the role of philanthropy and the early interest of systematic and organized philanthropy here in the U.S. So I think when it comes to developed market opportunities, we're in the private equity space. Self-declared impact, we're probably seeing more in the U.S. than in Europe.
Yeah, I would agree with that. I would say there's a cluster of activity that we see that's domestically focused in the U.K. in particular. But other than that, most of the private equity managers that we cover that are based in Europe are all investing abroad into Africa or Latin America. So.
No. Given that, I think we unfortunately are out of time. I just want to, first of all, thank all of you for coming. We have a standing room audience. It's extremely heartwarming for me to see how this sector, the interest has grown so dramatically in the last couple of years. A few years ago, we had this panel, been 4 of us and 4 of you, and that would have been it. This is really terrific. Please join me in thanking our panelists.